Hello, everyone. Welcome to this video on allowances and reimbursements. In the last video, we were discussing automobile benefits, that 2% times the cost of the vehicle for every month it's available. That's trying to calculate a benefit of using a work-provided vehicle. Allowances really comes into play often is what happens when I'm paying for something myself and then the work gives me money. When is it an allowance? When is it a reimbursement? So reimbursements come into play when we're considering actual costs. We have to recognize an income, economic benefits when I take part in a transaction and I end up ahead. If I, the employee, had to pay for certain employer expenses myself and my work pays me back, my expense is say $100. My work gives me $100 because that expense is related to the amount that I've received and they match. This is a reimbursement. I don't have to add anything to my income because I'm not being paid. I'm just recovering an expense I was out. So I have no economic benefit. I'm right where I was before the transaction. So we don't deduct the costs by the employee, nor is the reimbursement included in income. This similar is an accountable advance. Maybe I'm going for a work conference and my work says, okay, here's $1,000 to put against the trip, save the receipts and we'll account for any difference at the end. So if it turned out the trip was $1,200, my work gives me the difference. Or if it was $800, I have to pay them back. That's still the result of us ending up with the costs I paid matched the money I received. So I'm still no net benefit, so there's nothing to include. This is different from allowances or advances, especially when they're non-accountable. Allowances come into place when, let's say, I'm a salesperson, I go to a lot of conferences. So my work says, well, we don't really want to do the minutia of collecting all your receipts. So here's $800 a month, do with it what you will. So those allowances are just a set amount of money given to me. So I will include it in income, but from that income, I get to deduct the actual work-related expenses. So if they give me $800, I go to a conference and it only costs me $600, well, now I'm $200 ahead. So that's going to be included in income. But if they give me 800 and the conference cost me 1,000, well, now I'm out $200 and I should be able to deduct that difference against my employment income. So when we have those set amounts, those allowances and advances, those get included in income, but then I'm allowed to deduct the related expenses. So allowances are predetermined, arbitrary amounts, not based on actual cost. Your work's just estimating, here's $500, make it work, often provided for a specific purpose. So if I travel a lot, here's $500 per month for travel. Here's money for hotels when you go to conferences. So they'll be identified as being for something specific. If their purpose is not specified, then it's just considered additional income given or a bonus perhaps, and that will always be included in income. The ability to deduct the expenses, you have to identify the purpose because that purpose identifies what expenses I can take and use as employee chooses. So if they give me an advance of $800, I can go get a hotel room, get restaurants, and get food while I'm at the conference. But if I say, you know what, I really want to treat myself this weekend, I'm going to get a nicer hotel, maybe a spa treatment. Well, of course, those expenses are going to be above the allowance because they're not associated with the job. They're extra luxury I've paid for. So I can use the money as I see fit, but I'm only allowed to deduct the reasonable portion of the expenses. So despite the fact it was $1,500 for the hotel stay, I'm only allowed to deduct what a reasonable hotel stay would be, say $600. So it gives employees management choices over the money that they've received, but they still have to be reasonable in their expenses. So allowances, you can receive an allowance for personal or living expenses. Jobs that are in remote locations will often say like, here's living expenses of $1,200 a month to entice people to live in those remote locations. Those allowances are included in income. Taxable is any allowance that's unreasonable. Reimbursements are considered reasonable because they directly relate to the expenses. So if I get an allowance that matches those expenses, that's a reimbursement. If it's above or below those expenses, that's unreasonable. So the allowance will be taxable because it's unreasonable, but then I get to deduct the actual costs. So taxable allowances add to income, but I get certain deductions. Non-taxable allowances are reasonable to the expected expenses, so I don't include them in income, but I also will not be claiming the expenses. So that's the key thing. Taxable allowances in income have the expenses. Non-taxable, we just don't worry about them. We don't include them anywhere. So the word reasonableness was chosen by legislators to allow objectivity to be used. If an allowance is either unreasonably high or unreasonably low, it would be required to be included in income. So reasonable allows a bit of interpretation, and how they often gauge reasonableness is so if I go to a conference and I say, hey, my hotel was $1,500 a night, they might look at other people who went to the conference and say, well, most people spent $300 a night. That seems reasonable, right? So if most people can get a regular price, me spending a luxurious amount must therefore be unreasonable. Reasonable allowances for motor vehicles. In our discussion on automobile benefit, we identified that some vehicles are not automobiles, say police car, taxi, trucks that can fit only three people. So they're not automobiles, but when I use those cars for personal purposes, I would still recognize a benefit at this reasonable rate of 72 cents per kilometer. So the government's kind of established that if I use a company vehicle, the benefit is 72 cents per kilometer. So if that's the benefit to use someone else's vehicle, it's reasonable to say that's the cost of using my own vehicle. So businesses and employers can reimburse you at these rates, the 72 cents for first 5,000 kilometers, 66 cents after that. So if your work gives you a reimbursement of mileage for using your own vehicle at these rates, those are considered reasonable. You don't have to report an income, you just collect the money. Now, this rate is supposed to cover the gas used, the wear and tear on the car, potentially the insurance use for that specific drive if you break it all down. Um, so it's supposed to cover the cost or average cost for a specific trip. So to be considered reasonable, the allowance must be based on kilometers. So whenever we talk about reasonable rates, we're always based on a kilometer allowance. If it's not based on kilometers, if they say you're going to be traveling a lot, here's $500 a month, that's an allowance that will always be added to income, and then we'll deduct our mileage calculations ourselves. So employers like allowances because it's very easy. They don't have to go through the rigmarole of tracking receipts and expenses. They just say, we offer our staff, our sales staff, an allowance of $500 a month. They just accrue it every month, and that's it. They get the expense and it's done. And it'll be up to you, the employee, to keep those receipts because you want to be able to track those deductions on your tax return. If you're adding the income, you want to be able to deduct your expenses. So employers like the allowance, but employees, they like non-taxable allowance. I'd rather be able to collect money and not report it. And since they're not reporting the income, they don't need to keep track of the expense records. So employers like allowances, employees like, reasonable reimbursements. So there may or may not be a beneficial amount depending on the relationship between the allowance and actual cost. So if I get this 72 cents per kilometer, maybe that's not my cost. Maybe I have a very standard kind, I wouldn't say run down, but a reliable old vehicle, and it's not costing me 72 cents per kilometer. Well, then I really want this reasonable allowance because I'll still be able to collect that money, not report it on my income, but enjoy the benefits. So benefits don't always depend on the relationship between allowance and actual cost, but we do want to establish reasonableness. Okay, So we have a few exercises on allowances and expenses. So Miss Lauren Giacomo is required to use an automobile that she leases in performance of her employment duties. She receives a flat annual allowance of $3,600 for the use of her automobile. So because she's getting a flat amount, we are going to add this to income, but Lauren will be able to deduct the employer or business portion of her kilometers. So during the year, she drove a total of 24,000 kilometers, of which 6,500 kilometers were for employment. The rest was personal. Her total automobile expenses for the year, including lease expenses, are 7,150. So she has an allowance of 3,600. So she's adding this to her income. We can't deduct the entire 7,150, but we can deduct the portion of it that was used for employment. Now, the only way we have in the question to gauge what was personal employment is our number of kilometers. So it specifies, let me make this smaller so it fits on the screen. So it specifies that 6,500 kilometers were for employment, and the total kilometers driven were 24,000. So Lauren drove her car 27% of the time for business, for employment. So we'll take that same percentage and apply it against her total expenses times 7,150. So of her total vehicle expenses for the year, about 1,936 related to expenses paid for her employment. So she'll collect that $3,600 allowance. From that amount, she can subtract the 1,936. So if we go to the solution here, the employment kilometers identifies a percentage for business. The total expenses were 7,150, so 27% of 7,150 is total expenses of 1,936. We collected an allowance of 3,600, so that adds to income. Our business portion of our expense gets subtracted. So the net income inclusion, Lauren will have an additional $1,664 on her tax return from employment income. So that she has a bit of a benefit. They paid her more than it cost her to drive the vehicle for work. Let's do another allowance. Automobile allowance. So during the current year, Jacob Lorenz leases an automobile for $450 a month, a total of $5,400 for the year. He drives 60,000 kilometers total, of which 35,000 are employment related, 25,000 are for personal use. His total operating expenses for the year are $15,000. His employer pays him an allowance of 10 cents for each kilometer related employment related kilometer driven, a total of $3,500. So 35,000 kilometers were the amount paid for driven for work. 10 cents per kilometer, $3,500. So that's how much he got from his workplace. To be a reasonable allowance, automobile allowance, it has to be based on kilometers, and his employer is basing it on employment related kilometers. So it could be said this is a reasonable allowance. The thing is, at 10 cents per kilometer, it's wildly below those reasonable rates that were established by the CRA. So the rates don't have to be that 72 cents. I think that's the maximum, but 10 cents is just really low. So we suspect we're not getting a proper allowance to cover our employment expenses. So it's in Jacob's interest to argue that this is an unreasonable rate. If it's unreasonable, then we can add that 3,500 to income and we can subtract our expenses. So let's take the total kilometers driven were 60,000 and 35,000 were for business. 58, about 58.33%. That's how much of the kilometers were for work. Total expenses were 15,000. Plus, we also had $5,400 for lease, 5,400. So our total expenses for the year to drive this vehicle was $20,400. So at $20,400, we established that our percentage was 58 times 0.5833333. Our expenses are $11,900 if we round this to the nearest dollar. So they gave us $3,500 to drive for employment, to use our own vehicle. But given the number of kilometers we drove, it cost us $11,900. So we want to report the income. We want to report the $3,500 so we can subtract the difference. If we look at the solution, automobile allowances, 58% was for business. Our total received was 3,500, but we get to take and deduct 58%, this amount, of our total vehicle costs. 20,004 times 58 is 11,009. So by reporting the allowance, we'll be able to deduct a net $8,400 from our income. We'll add the amount, deduct our travel expenses. So our tax return is actually going to show a subtraction of $8,400 from our work expenses. So in this instance, the employee would want to take the stance that 10 cents per kilometer is unreasonable because that's what allows us to report income and report deduction. I think there's one more I'd like to do in this video. Bear with me. Travel allowance. This one's a bit long, but we'll get into it. Sandra Ohm travels extensively for her employment through British Columbia. Her employer provides a daily allowance of $200 to cover hotel expenses. Assume the daily allowance is considered reasonable given the circumstances. In addition, she's paid 58 cents per kilometer when she's required to use her own automobile for employment-related travel. This per kilometer allowance is based on current published numbers by the Provincial Automobile Association for average costs of a vehicle. So that long sentence is trying to say the $200 to cover the hotel expenses is reasonable. That per kilometer rate of 58 cents is reasonable. So when we get to the end of that first paragraph, there's nothing here we have to report. The money that Sandra's getting are both considered reasonable rates. If they are reasonable reimbursement rates, there's nothing to include in income, right? Reasonable allowance or non-taxable. But maybe we do want to include it. It's going to depend on what are our actual expenses. So let's take a look at Sandra Ohm's expenses for the year and see if she's better off claiming the deductions. In the current year, she traveled 82 days for work and drove 9,400 kilometers for employment-related travel. Her employer paid $16,400 for hotels. That's $82, $200 per day for 82 days. So she received $16,400 for hotel allowance and got paid an additional $5,452 for her kilometers driven, being employment kilometers times 58 cents. The actual hotel expenses were $18,300, so we paid more than we received for the hotel allowance, but the automobile expenses were $7,200, which is also a bit more than the $5,452, but this $7,200 needs to be allocated for business purposes. During the year, she drove a total of 23,500 kilometers, of which 9,400 were for employment. So 9,400 divided by 23,500. The employment portion of her kilometers is 40%. 40% times our expenses of 7,200 is 2,880. So she received an allowance of 5,452, which is well above her actual expenses. So we're over on the hotel, we're less on the kilometers. Let's see what it comes out to. So the allowance that Sandra received, $200 per day for 82 days. There's the 16,400. She drove 9,400 kilometers at 58 cents each. There's the 5,452. So in total, Sandra received $21,852. That's how much her work provided to her for using her own company, her own vehicle and staying in hotels. The actual cost was 18,300. Now, all of those stays were for business. We take the full amount. The cost of the mileage was 7,200 to use the vehicle. 40% of it was for work, so 2,880. So the total expenses is $21,180. So it's pretty close. Our total expenses are very close to the income received. The income's just a little bit more. So if we were to add the income and deduct the cost, our net inclusion would be $672. So we'd be adding money to our income. But lucky for us, we don't have to include that income because these rates are reasonable. So Sandra's better off taking the reasonable allowance. She can collect this money, report nothing, and she comes out a little bit ahead, about just short of $700. So this is good. This is in Sandra's favor. That's the importance of reasonable rates. If it's reasonable, we don't have to report it. We just get to enjoy that small benefit. Okay. That is the discussion on allowances. Thank you for your time. When I see you in the next video, we'll discuss other inclusions, and I think we're going to talk a bit about insurance. Later in the chapter, we're going to be discussing stock option benefits. Look forward to those videos. See you in the next one.